What if I told you that while everyone chases yesterday's headlines, the smartest money is already positioning itself in a select group of companies poised for unprecedented growth? Forget the noise and the fleeting trends. I'm about to uncover 5 undervalued giants, or maybe even under-the-radar innovators, that are quietly building immense competitive advantages. These aren't just stocks. They're strategic plays on the future of technology, energy, and industry. Stay with me, because the insights we're about to reveal could fundamentally shift your portfolio's trajectory. First up, we have Autodesk Incorporated, ticker ADSK, a true titan in 3D design, engineering, and entertainment software. Autodesk is the backbone for architects, engineers, construction firms, manufacturers, and media giants worldwide. Their recent financial performance of Q2 beating analyst expectations. Revenue soared by 17% year-over-year to $1.76 billion, and EPS hit 2.62, comfortably above the 2.45 forecast. What truly sets Autodesk apart, however, is its relentless focus on AI integration. Their auto-constraint feature in Fusion is already boasting an 80% user acceptance rate, showing immediate, tangible value from AI. The company is even transitioning to a consumption-based pricing model for AI-driven features, aligning its growth with the direct value it delivers. Management has grand ambitions, targeting a long-term operating margin expansion to 41% by fiscal 2029. The architecture, engineering, construction, and operations segment is currently a powerhouse, fueled by sustained investment in crucial sectors like data centers, infrastructure, and industrial buildings. Their construction business is growing steadily, with their make business expanding at around 20%, indicating healthy demand for their core offerings. Of course, no investment is without its risks. The valuation, with a forward PE of 30.72, is elevated, which can be a concern for value investors. And yes, they do carry a moderate level of debt. However, with 24 analysts revising earnings upward and a median price target of $363.71, the market clearly sees significant upside. Next, we have Canadian Solar Incorporated, ticker CSIQ, a global powerhouse in solar energy and battery storage. This company is not just making solar panels, they're building the future of sustainable energy, with manufacturing operations spanning North America and China. Now, you might have heard about the volatility in the solar sector, but Canadian Solar has been bucking the trend with a remarkable nearly 50% stock surge over the past 6 months alone. Their e-storage subsidiary recently completed a massive 220 megawatt-hours battery project in Australia and locked in critical contracts in Ontario, totaling an astounding 420 megawatts, 2,122 megawatt-hours. However, it's crucial to acknowledge the challenges. Canadian Solar grapples with a substantial debt burden of $6.5 billion and has historically struggled with profitability, evidenced by its negative PE ratio of negative 143.88. This indicates a company in a growth-heavy, capital-intensive phase, prioritizing expansion over immediate bottom-line returns. The company plans to scale its energy storage capacity from 10 to an impressive 24 gigawatt-hours by 2026, while simultaneously boosting battery cell capacity from 3 to 9 gigawatt-hours. As of mid-2025, e-storage has already shipped over 13 gigawatt-hours of battery energy storage solutions globally, backed by a contracted backlog valued at $3 billion. Of course, the company still faces headwinds from ongoing tariff issues and an oversupplied global solar module market, which continue to pressure margins. While analysts project continued losses for the next 3 fiscal years, with an average EPS forecast of negative $3.61 for fiscal year 2025, improving to negative $0.75 by FY 2027, the market sentiment appears to be shifting. Technical analysis indicators are flashing a strong buy, suggesting that despite the fundamental challenges, investors are optimistic about the strategic pivot towards higher-margin energy storage solutions and their expansion into key markets like Australia and North America. Trading at a low price-book ratio of 0.35, Canadian Solar offers an intriguing entry point for investors willing to bet on the long-term energy storage narrative, despite the near-term profitability struggles. Moving on to Littelfuse Incorporated, ticker LFUS. A company founded way back in 1927 and headquartered in Rosemont, Illinois. Littelfuse is a hero in the world of electronics, quietly designing, manufacturing, and selling critical electronic components, modules, and subassemblies. Their electronics segment provides everything from fuses and circuit protection to magnetic sensing and advanced semiconductor components like metal oxide semiconductor field effect transistors and insulated gate bipolar transistors. Meanwhile, their transportation segment ensures the safety and functionality of vehicles across heavy-duty trucks, buses, construction equipment, and even marine applications. Littelfuse delivered a strong performance in Q3 2025, exceeding expectations with adjusted EPS of $2.95 against a forecast of $2.80, and revenue hitting $625 million, above the $622.92 million consensus. However, the market, ever sensitive to future guidance, reacted negatively, with shares dipping after management issued a weaker Q4 outlook. This highlights a classic investor dilemma: strong current performance versus cautious forward guidance. Q3 revenue saw a 10% year-over-year increase, with the electronics segment leading the charge at an impressive 18% total gain, showcasing robust demand for their core protection and sensing solutions. Adjusted EPS of $2.95 signals resilience, especially after a challenging fiscal year 2024. Their track record of maintaining dividend payments for 16 consecutive years and raising it for 15 solidifies their reputation as a financially disciplined company that consistently returns value to shareholders. Key strategic moves include the announced $350 million acquisition of Basler Electric, a deal expected to be accretive to EPS from 2026, bringing in an additional $125 million in annual revenue and high-teen EBITDA margins, while the PE ratio of 30 times LTM is elevated, raising questions about valuation. The consensus analyst price targets range from $280 to $325, suggesting a healthy upside from its current price of $241.22. Littelfuse is a company with strong fundamentals, a long history of profitability, and a strategic vision for growth through acquisitions and expansion in critical segments. While short-term headwinds may create some volatility, its long-term trajectory, driven by essential products and a commitment to shareholder returns, makes it a compelling prospect for those seeking stability with growth potential. Our fourth promising stock is Oracle Corporation, ticker ORCL, one of the leading enterprise software and cloud computing provider. For decades, Oracle has been the bedrock for countless businesses, managing their data and applications. Oracle has strategically pivoted, transforming itself into a critical player in the rapidly expanding cloud and AI landscape, primarily through its Oracle Cloud Infrastructure, or OCI. Oracle's stock has delivered an eye-popping 55% one-year change, proving its ability to adapt and thrive in a dynamic tech environment. Its gross margin hovers around 70%, showcasing incredible profitability in its core offerings. The recently announced $300 billion computing agreement with OpenAI isn't just a contract. It's a sign of OCI's growing capabilities and its critical role in powering the future of AI. This single deal, alongside others with tech giants like xAI, Meta, NVIDIA, and AMD, has sent Oracle's remaining performance obligations soaring to over $455 billion, a staggering 359% increase year-over-year. Oracle Cloud Infrastructure revenue itself has surged by 54%, with OCI consumption revenue growing at 57%. This is explosive growth, driven by the insatiable demand for high-performance cloud infrastructure to train and deploy complex AI models. Its established relationships with enterprise customers provide a formidable moat, and its 12-year dividend growth streak signals a commitment to shareholder value. Despite these strengths, Oracle faces challenges. Some technical indicators flash a strong sell, and the stock has experienced recent volatility. The company trades at a premium valuation, with a PE of 63.5 and a forward PE of 39.7, which warrants caution. It also carries high valuation multiples across earnings before interest and taxes, EBITDA, and revenue, and its short-term obligations exceed liquid assets. Intense competition from AWS, Microsoft Azure, and Google Cloud, who command larger market shares, is also a constant factor. With 8 analysts revising earnings upward for the upcoming period, the institutional confidence in Oracle's long-term strategy remains strong. Finally, we have Zebra Technologies Corporation, ticker ZBRA, a global leader in enterprise asset intelligence and automation solutions. Zebra isn't just selling hardware, they're providing the critical tools that power efficiency and intelligence across retail, healthcare, logistics, and manufacturing. Think barcode scanners, mobile computers, RFID technology, and the software that ties it all together. Zebra is the silent force optimizing supply chains and improving operational workflows globally. Zebra Technologies delivered a strong Q3 2025, beating analyst estimates with EPS of $3.88 against $3.73 expected, and revenue reaching $1.32 billion, representing a respectable 5% year-over-year growth. Adjusted EBITDA margin improved to 21.6%, signaling efficient operations. The Asset Intelligence and Tracking segment was a standout, posting 10.6% organic net sales growth, demonstrating robust demand for their core data capture technologies. Geographically, Asia-Pacific, Latin America, and North America showed strong performance, highlighting diverse market penetration. However, the market's reaction was swift and unforgiving. The stock tumbled over 12% in pre-market trading, reflecting investor anxiety over uneven regional performance, potential U.S. tariff impacts, and uncertainties about sustaining organic growth into Q4 and 2026. Despite this knee-jerk reaction, Zebra's Q4 2025 outlook projects sales growth of 8 to 11% with an adjusted EBITDA margin of around 22% and EPS between $4.20 to $4.40. While analysts noted concerns about flat organic volumes and margin pressures from tariffs, the underlying business remained strong. Strategically, Zebra completed a $1.3 billion acquisition of Elo Touch Solutions, expanding its footprint in self-service technology across retail and healthcare, a smart move to capture growth in automation. They also announced a $500 million share repurchase program, indicating confidence from management and a commitment to shareholder value. With 13 analysts revising earnings upward and a PE ratio that is low relative to near-term earnings growth, Zebra Technologies presents an intriguing opportunity. While the stock has seen volatility and it doesn't pay a dividend, its leadership in essential automation solutions, combined with strategic acquisitions and share buybacks, could provide significant upside once market concerns about short-term headwinds subside. TD Cowen rates it a buy, with a $400 target, calling the recent drop overdone. This suggests that for long-term investors, the recent dip could be a tactical entry point into a company with a proven track record and a clear path to future growth. Now, let's take a quick look at the numbers. Starting with current price, Oracle Corporation and Littelfuse are both trading significantly higher at $248.17 and $241.22 respectively, with Zebra Technologies close behind at $260.35. On the other end, Canadian Solar is a true bargain at just $21.94, making it accessible to a broader range of investors, while Autodesk sits at a premium of $300.86. When it comes to market cap, Oracle is the undisputed giant, commanding a massive $790.2 billion, which dwarfs all others on this list, indicating its immense scale and global influence. Autodesk follows at a respectable $65.5 billion, and Zebra Technologies at $15.3 billion. Canadian Solar, at just $992.4 million, is a much smaller player, highlighting its growth potential if its strategies pay off. Shifting to revenue, Oracle once again leads with a staggering $59.0 billion, showcasing its vast market reach. Autodesk and Canadian Solar follow with $6.6 billion and $5.9 billion respectively, while Littelfuse brings in $2.3 billion. Zebra Technologies shows the smallest revenue at $2 billion, suggesting it's a more specialized player. Gross margin is where profitability gets really interesting. Autodesk boasts an incredible 83.67%, with Oracle not far behind at 70%. Zebra Technologies maintains a healthy 48.59%, while Littelfuse comes in at 36.15%. Canadian Solar, reflecting the competitive nature of the solar module industry, has the lowest gross margin at 29.8%. As for dividend yield, only Littelfuse and Oracle offer payouts at 1.18% and 0.77% respectively, appealing to income-focused investors. The others are reinvesting their earnings for growth, which is common for companies in expansion phases. And finally, earnings per share tells us who's truly profitable. Zebra Technologies leads with an impressive $13.5 per share earnings, followed by Littelfuse at $8.48 and Autodesk at $8.47. Oracle also posts a strong $6.03 per share earnings. Canadian Solar, however, is in the red with an EPS of negative $0.45, reflecting its heavy investments and the competitive pressures it faces. So these are 5 promising stocks, each with a compelling growth story and significant upside potential. Which of these 5 stocks do you believe has the best shot at explosive growth potential in 2025 and beyond? Drop your thoughts, insights, and predictions in the comments section below. Let's get a discussion going. And if you're looking for even more hidden gems or strategic plays, don't miss our video right here on 6 best performing long-term stocks according to analysts. Click on this video here.